Hello everyone, my name is Radovan Vojtko, I'm CEO and the head of research at Quantpedia. So today I have something special for you. I would like to show you the anomaly or trading strategy that for me personally is one of the favorite one that we have found out over the last 6 months. It's a market timing strategy and it's about the gold. So we have around or over 200 market timing strategies in our database. I personally like them a lot. The advantages of market timing strategies are that if it's built correctly, it's easy to execute. So you are just buying and selling the market, just one individual market. You do not need to trade a lot of multiple markets unless you want to, combine multiple strategies together. So let's get to it. The strategy or article is called Cultural Calendars and the Gold Drift. And what is the theory? So there are 4 main religious domains in the world. It's Christianity, Islam, Hinduism, and East Asian syncretic traditions like Chinese Confucianism. All of them altogether encompass approximately 6 to 7 billion of the people. So those 4 religions, they are the majority of the people that are on the planet. And in each cultural or religious tradition, there are holidays with the gift-giving rituals.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
So what does it mean? The best example is the Christianity. So in the Christianity we have a Christmas, and during the Christmas, we tend to give each other small gifts or bigger gifts. It depends how wealthy we are. The reason for that is to the people we like, even to surprise them and give them some gift. But however, all of us are the humans, so from time to time we tend to show off and we want to display the wealth. And it's not the specialty of the Christianity. So the same religious holidays are also in the Islam, in the Hinduism, and also in the Chinese Confucianism. So in each of those religions there is a public holiday during which people tend to give each other the gifts. And the question is, what are those gifts? There are usually some consumer discretionary things like on your cell phones and stuff like that. However, a lot of the time when you want to show off your wealth, you are giving the gold. What we can expect, in the theory, is that there will be like buying pressure or there will be a small drift in the gold prices around those holidays. And we backtested this idea and we realized that this idea holds and we can base a trading strategy out of that. So that's absolutely great. Okay, what we did. So we identified gift-giving rituals or gift-giving public holidays. There is a Christmas for Christians, Eid al-Fitr for Muslims, Diwali for Hindus, and Lunar New Year for East Asian communities. So those are like 4 primary public holidays or wealth-oriented celebrations that we identified in those 4 main religions. Okay, then we downloaded data. We downloaded the GLD ETF because it's easiest to trade, and we found out the schedules. So when those holidays are from time and date, and we ran the analysis on the D-3 to D+3. And here is the initial analysis. Keep in mind that the D0 is always the day when there is a holiday, and D-1 is a day before the holiday, D+1 is day after the holiday. The calendar is based on the Gregorian one, so because we are trading the GLD ETF, the New York Stock Exchange. During the Christmas, of course, the New York Stock Exchange is closed, so D0 is no performance, but during the Diwali or other celebrations in other parts of the world, the D0 market is open because New York Stock Exchange is open, so there is a D0 performance also. So let's take a look. We have a nice drift before the Christmas and after Christmas in the gold price. So there is definitely drift in the gold around the Christmas. Then we have the Eid al-Fitr, which is the Muslim celebration. Here we can see that on D0 is a little negative performance, but on D-1 and D+1 is a positive performance. The next one is a Diwali. So once again we see that there is a significant drift in D-1 and there is significant drift in D+1. And the last one is the Chinese New Year. In the Chinese New Year, once again we see that there we have a drift in D-1 and D0, and a few days after the Chinese New Year. So what is the simple trading strategy? So the simple trading strategy is that we can try to buy the GLD at the close of the day D-2. We can hold it during the 3 days, so it means 1 day before the celebration, during the celebration, and 1 day after the celebration, and we can liquidate at the end of the D+2 day. This is like the idea for how you can build up the strategies, and here are the performance curves of all of the 4 individual religions. We can see that the Muslim Muslim celebration on the Muslim Alpha feeder public holiday is probably the weakest one. The Christmas is the strongest one, but the Diwali and Lunar New Year, I mean, when they are combined together, they are even stronger than the Christmas. So the average performance by the region of the individual celebrations is approximately 0.5%. So when we combine all of those strategies together, here is what we will get. The final strategy has performance around 2.3% with a low volatility, a Sharpe ratio of 0.7, a small maximum drawdown. So what does it mean is that when we trade this effect 4 times a year using the gold ETF, we will get approximately 0.5% per each holiday. So I mean over 2% in the year, and we will make just 4 trades. We can easily leverage this strategy, or we can use this strategy as an add-on to any portfolio of the strategies, because it's very simple to execute, it's very simple to leverage, and you can basically edit a bunch of existing models as an additional model, and you will have boost in the performance with a relatively low risk. So I mean that's the reason why I really like this strategy, because we already have the portfolio of a lot of the strategies and they are mixed together, and it's very, very easy to add this one into the whole portfolio. So I hope that you like this research. I hope that you'll test it yourself. When you try to replicate and when you try to implement the strategy, you will find out that it's really easy to implement, and it has a very interesting performance, and as I said, it's simple and it really makes sense to add it to your portfolio. So if you like this video, please give us the like, subscribe to our channel. You can watch other videos. I mean, we are always trying to find and come up with some interesting and easy trading strategies that you can implement by yourself. So thank you very much.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.